Welcome to the Deeper Dive, the show that unpacks the why behind the market's what. I'm your host, Alex.
And I'm Christine.
Christine, it's fantastic to have you back. Today we're tackling a topic that feels more relevant than ever. What actually happens in the market when a geopolitical crisis erupts?
Yeah.
We all know the feeling. A single alarming headline flashes across the screen, and in an instant, it feels like every trading portfolio in the world is just a sea of red.
It's that visceral risk-off moment, Alex. The what is painfully obvious. Stocks are falling, and often falling fast.
Right.
But the why, that's a fascinating, multi-layered cascade.
Hmm.
It's not one simple reaction, it's a story that, unfolds in distinct chapters.
And that story always begins with the first chapter, pure, unfiltered shock.
Right.
This isn't logic, it's a gut reaction. It's driven by emotion and by these high-speed trading algorithms that are programs to react to threatening keywords and headlines before a human can even finish the sentence.
And we can actually measure that shock in real time.
Okay.
That's the first indicator everyone turns to, the VIX, the CBOE Volatility Index.
The VIX.
So for our listeners, think of the VIX as the market's heart rate monitor. When it's sitting quietly around, say, 15 or 20, the market is calm.
But when a crisis hits and the VIX suddenly screams up to 30, 40, or even higher, it's signaling a major cardiac event.
Wow.
It's the market's collective gasp for air. This is the sell first, ask questions later phase. But confusing this initial shockwave for the whole story is a classic mistake.
Exactly, because almost immediately after that first tremor, a second, more calculated reaction begins.
Okay.
This is Chapter 2, the Great Flight to Safety. The money doesn't just evaporate, it runs for cover.
So, Christine, where does $1 trillion go to hide when it's scared?
It sprints towards the age-old fortresses of finance.
Right.
First, there's gold. For millennia, when trust in paper money or governments falters, humanity has turned to this physical, tangible metal. It's the ultimate non-sovereign store of value.
The second fortress is U.S. Treasury bonds.
Yep.
They're essentially the safest IOU on the planet, an unconditional promise to pay from the world's largest economy. You also see flows into so-called safe haven currencies, right? Like the US dollar and the Swiss franc.
Yeah.
The underlying theme is just a desperate search for security.
But what's fascinating is that this isn't just about leaving stocks.
Right.
A huge repositioning also happens within the stock market. This is Chapter 3, the strategic sector rotation.
Ah.
It's like a massive river of capital just changing its course in real time.
And you could see it so clearly. Money flows out of what we call cyclical stocks. These are companies whose fortunes are tied to economic confidence. Think airlines, cruise lines, luxury car brands, high-end retailers.
Right.
Their prospects just dim when the future looks uncertain.
Precisely. And that money flows into defensive sectors, the essentials of modern life.
Okay.
The most obvious beneficiaries are, of course, defense and aerospace companies as nations reevaluate their security and increase military budgets.
Makes sense.
Then you have energy stocks, which can surge on fears that the conflict will disrupt the global supply of oil and gas.
And you can't forget the less glamorous but critically important workhorses.
Right.
Utilities and consumer staples. I mean, no matter how tense the world gets, people are still going to turn on their lights, buy groceries, and use basic healthcare products.
Yeah.
The demand for those things is incredibly stable, and in a crisis, investors fall in love with stable.
So we've journeyed from blind panic to a fearful but logical reallocation of capital.
Yeah.
But this is just the setup. The real analysis, the kind that determines whether this is a one-week correction or a one-year bear market, that goes much deeper.
Right.
This is Chapter 4, the second-order effects.
This is where the pros really try to separate the headline from the trend line.
Yes.
They start asking the tough, granular questions. Okay, a conflict has erupted. Does company X have factories in that specific region? Is it supply chain for a critical microchip running through that port? That's the direct first-order impact.
But the indirect, the second-order impact is what can shake the whole system.
Wow.
It's a disruption in a single shipping lane, like the Strait of Hormuz or the Suez Canal, can add 10% to the price of oil almost overnight.
And that's not just a problem for oil companies.
No.
It hits everything from airline fuel to the cost of making plastic toys to the price of shipping food across the country.
And that leads us to the single most important variable the market obsesses over in these moments:
Which is,
inflation. Because geopolitical shocks, by disrupting supply chains, pushing up commodity prices, are almost always inflationary.
and this, Christine, puts the world's central banks in a truly impossible position.
Totally.
This is the real high-stakes chess match.
Exactly.
On one hand, the economy might be stumbling because of the crisis,
Mm,
which normally calls for the Fed to cut interest rates to support growth and employment. But at the same time, inflation is taking off,
right.
which demands they hike interest rates to control prices. So what do? Do they support the economy and risk letting inflation run wild? Or do they fight inflation and risk pushing a fragile economy into a recession?
Yeah,
That uncertainty, that giant question mark hanging over the Fed's next move, is what the market truly fears more than a bad outcome itself.
exactly.
A known negative can be priced in. An unknown policy path is paralyzing.
So, to recap the market's journey through a crisis,
Okay,
it starts with a jolt of raw fear, quantified by the VIX. Then comes the more logical flight to the safe havens of gold and bonds.
right.
After that, a strategic rotation into defensive stocks. And finally, the market settles in for the long haul, analyzing the real economic fallout, and most importantly, trying to read the minds of the central bankers.
Thoughtfully. It's a multi-stage process of discovery.
Mm-hmm.
And while history shows that markets are surprisingly resilient over the long run, the key for any investor, novice or pro, is to understand which stage of the game is being played and not mistake the opening move for the end game.
That is the perfect setup for our closing thought.
Indeed, it is. Now, here's a question we'd like you to think about. For decades, a common piece of investment wisdom was to simply buy the dip on geopolitical events,
Right.
trusting in long-term market resilience. But has the game changed? In today's deeply interconnected world where a regional conflict can instantly trigger global inflationary pressures and complex central bank dilemmas,
Wow.
is it still enough to just have faith in the rebound? Or does today's investor need to differentiate more carefully than ever before between short-term noise and a fundamental, game-changing shift in the global landscape?